Shavyfxhub. So this is for the 5 minutes. So we looked at, I think we're going to draw this chart using our line chart alone to enable us get clear areas of reaction in the market. And one of the key mistakes you make while analyzing the financial market is you you jump time frame in your charting. If you chart on 1 hour, now the question you ask yourself is which time frame are you using as your point of entry? So if you're charting on 1 hour and you want to use 1 hour as your point of entry, most likely you have to remain there. The biggest mistake gonna do is you chart for the 5 minutes in search of a point of entry and you gonna switch to 30 minutes or 15 minutes. Honestly, you're going to lose the market reaction. You're going to lose it because if I switch this chart to 1 hour, the key areas of market reaction that I'm enjoying now, I will no longer have it. They are going to jump. So you must stay to what you invest in. If you invest in anything, you wait for it, let it come to you. You must wait to allow it to come to you. You know. So I'm gonna stay through the 45 minutes. I've checked 30 minutes. I didn't like 30 minutes price action because I will show you why I didn't like it. And I mean it's optional. You can choose different time frame you like. But for me, I've done what I wanna do. So now my goal is to reap from this structure, from the retest of this structure. That is what I want to see on 45 minutes. So on 45 minutes, if price comes back to this area, then I want to see if it aligns with my structure. The structure of the market at this level is given a potential sell opportunity on a retest to the supply roof, except price finally breaks the supply roof. If they cannot break the supply roof, then they cannot go continuously upward. So this is just what it is. You can see my structure. What I'm trying to maintain is after break of a demand floor, I want to maintain series of successful tested supply roof, and we will continue to track it to see until finally the structure is broken. But at the moment, we have a breakout from a demand floor, and the price been respecting that breakout. So we continue to hold that structure, and that's what we'll see. This is a 45 minutes time frame line chart. So you can see the structure. So I'm going to change this. Now I've gotten my floor, I've gotten my roof. Look at the angle of trend on the floor where price established here as a supply roof, supply roof, supply roof, supply break of a supply roof, price turns you on demand one, on demand two, on demand three. And there's a very likely probability that when price returns here, it's still going to respect the structure. So we're very hopeful that when it comes there, it will react. It will react when it returns there. Very, very hopeful. Very, very hopeful it will react there. So that 39 was a big smash. Was a big smash. It was based on structure. So I'm going to show how that market rejected that level. It wasn't a coincidence. It wasn't a manipulation. It was respecting the structure of the market. And those who have sold at that level were selling at that level to respect the structure of the market. So that was why they did that. So another structure we found here, we found under descending structure, which market participants also respected it. So a majority of the moves in the market follow the principle of market structure. They will always respect it. That's what you don't know. They will always respect it, regardless. So the earlier we get it this way, maybe the better for all of us. The earlier we get it that way, the better for all of us. You can see that structure and the potential breakout from that price return here as a supply roof, break of a supply roof. Whatever reason returns here to respect the supply roof. Break of a supply roof becomes a demand floor. Break of a demand floor becomes a supply roof. and the break of a supply roof becomes on demand and price have left. Let's see what we got here. And you can see that retest on that structure. You can see the retest after break of a supply roof, price returns on demand and significantly showing that push up. So that is what it is. And let's add some zone to it just to for clarity purpose. So when market returned there, it broke that structure and retested it and made its way up. My goal is to see price return back to this structure. That is all that I want to see. A return into this structure will ultimately look out for another potential sell opportunity in line with the structure of the market. This is mathematics. It's not just theory, it's pure mathematics. So you must understand the pattern and pay critical attention to the pattern of the market. The pattern will always be the same. The result will always be the same. So in this case now, you want to see price return back into retest, like the way it has drawn liquidity from this level. We have a draw liquidity after break of structure from this level. We have another draw liquidity from this level. And the model of all draw liquidity is going to be at 2,970 something. And the new candle is about to start 45 minutes after rejecting this floor. So what we want to see now is why did price reject this level? So why did price reject 39 level? So let's look at the structure finally before we draw our line and watch to see finally what she does at that level. So you go back to your line chart and you will see that we have a structure at this level. We have a 45-minute structure at this level. Now it becomes our new upswing or uptick litmus test. Yes, we want to continue uptick, but you cannot move up without evidence. So there must be presence of sheer upward momentum, indicating the presence of liquidity. And that is what's going to change the bias of majority of retail traders to key in into institutional demand. So if the institution is buying, then the retail traders need to see the momentum. And one of the signals and one of the things that tells you about that signal is the presence of break of structure. So at this level, they need to break this level. If price manage to break this level, then it will signal presence of buy momentum. And once that's perceived, a lot of buyers are going to change. The reason they are going to change is because many stop loss that are hit have no option but to get back into the market in a revenge bid to return back their capital in direction of the current trend change. So you see that black ascending trend line, which we have in our line chart. Previously here, supply roof, break of a supply roof, price return here used as a demand, break of a demand structure, price returns here on supply, break of a supply roof, price returns here on demand. And price returns break a demand floor used as a supply roof and sold down where it peaked liquidity in line with the ascending trend line. The ascending trend line was a previous supply roof, a long-term supply roof. So let's put our chart on it so we can see the history where this started from. So everything is well programmed, well programmed. So I don't want to hear manipulation things here. So let's see it. So this is how we want to identify this stuff. And okay, you can see that structure. So price create a demand floor there, break of a demand floor. So technically creating a future supply roof, which is this, after the break of that demand floor in that time frame. The price returns here as a supply roof. It returns here again as a supply roof. Before break of a supply roof, it returns it now on demand. And technically the price is in a long-term demand phase. So on technical, we should expect that price should keep this uptick probability high. Now, for us to fly higher, we want to break the structure of this black ascending trend line. So if that structure is broken on technical, then that will open way for more buy. That will open way for more buy. So look at it here. So if we manage to break this black structure, then we have no option other than to retest 2,976. So this invalidates our previous sell order. You know, as the day unfolds, as the time moves, charts and sentiments has to be adjusted based on what the market is doing because you want to trade in reality. It's not by assumption. Everything we're doing has to be on technical. So we are seeing that that rejection at 39 wasn't just a coincidence, but was a structure of a market that participants saw and they want to respect it. Because here we have a very strong demand structure. A break of that demand structure came with a retest and price has sold. So on technical, it still owed that zone a retest. A previous demand that was broken in the future, in the present, becomes what? A supply roof. And that's what price has done at that level. And if you go back again to your bar chart, you will see it. That was when price came, they respected that structure. Now they are trying to buy it back. So why are they buying it back? After breaking the structure, we have another strong demand. So you can see here at this level, we have a strong demand structure. So market is keying into that structure in anticipation that it could be the foundation for further uptick. A break below that structure will be changing bias and also be a clear indication of lack of liquidity in the market and inability to break the relevant market structure for it to uptick properly. So at this phase now, you see this market here. You can see the market here. So now here we have a very strong structure at this level. So the market will continue to use here as a optic foundation, right? So if it breaks it, then let us forget about going further up. Now what we'll now look for is now sell opportunity so that the market will return in line with the previous bearish impulse. Don't forget, we already have a bearish impulse at this level, and the bearish impulse has not been invalidated. Invalidation of this bearish impulse will mean the break of the supply low. That is the high of that bearish impulse. We need to break it. So if we break it, then we are no longer binded by this force. But as long as price continues to trade below this structure, it's still under the bearish impulse drop. So price must demonstrate liquidity, price must demonstrate optic to be able to break that structure for us to be relieved from the influence of that sell. Look at what the sell has done. A very strong, massive drop. Every attempt to buy it back failed. Whoever that tries to buy this will be in pain, will be in severe pain. You're going to be in severe pain trying to buy within this structure. So what happened is that price returns again to respect it. There is a very high probability that it's going to create a similar pain. Look at the volume of the pain. You can see the volume of the pain created here by the market. So there is a very high probability that at this level it will replicate the same amount of pain. There's a very high probability. So you must be very, very watchful. So the only time you can sit down and rejoice is and when price breaks above 2,938.62. A break above that zone will imply a broken supply will become demand floor. So on that footnote, you now look for an opportunity to go into the 70 zone. So that will represent about another 400 pip move in the market. Gold is destined to hit $5,000 per ounce. Like I spoke in my previous charts, the United States is trying to revalue their gold reserve from Federal Reserve in order to meet up with their debt payment expectation, over $32 trillion in debt. And they are also wondering how they're going to pay that money while curbing inflation. The Federal Reserve have not reached their mandate of 2% inflation curb. Inflation is still very high, about 3.7%, based on the last data we received. So they are doing all it takes in order to service their debt. So in the course of servicing their debt and trying to pay off, they have to sell off certain assets. And one of the ways they will do that is to return gold standard. And if gold standard is returned, they could revalue their gold to 10,000, 15,000, or even $20,000 per ounce of gold. So it's very technical, it's very cunning, and they have bought back. And recently, a lot of gold bars, physical gold bars, have been moved out from London gold markets and been moving to New York and Michigan. So these are data that you must keep in track and know that these are realities that affect the market. We are not talking of paper contract. We're talking of physical gold owning. There is shortage. So that shortage of physical good earning is actually driving the price. That is what it means. It's driving the price astronomically. So it's not just speaking it in my people want to buy and hold. We are talking of buy and hold. A lot of countries have been buying digital gold now want their gold physically. It's just like everybody marching to the bank. I need my money. If over 20,000 people or 30,000 people approach any bank that they want their money, the bank can pay them. The bank cannot pay. There's no way the bank can pay. So you see, oftentimes what you're dealing with is digital good and digital currency. When it turns fiat and you want your cash, raw cash, that's where you see the problem comes in. So we are going to see a lot of demand surge for 2025, and according to analysts and what information getting from commitment of trade. It shows that there is very high demand among retail traders to stockpile physical gold. The demand right now is for physical gold and physical silver, no longer paper gold. I mean, who wants a paper gold? If I have a vault in my house, why should I keep paper gold in my house? So you want to have the real gold bar, because he's the one who has the real gold bar is the one who is considered rich. So, as a store of value in terms of geopolitical tension, in terms of political instability, gold remains a top tier asset. It will always be a top tier asset, always. So, shortly after this, we're going to look at the structure of silver to see what silver and copper is doing. So let's be very hopeful and watch if we can have a breakout from this structure. If we have a breakout from here, then we are rest assured that we can now seal into 2,974, 75, possibly into 80 before we look for another potential sell opportunity in line with the price action. So this is what we see at the moment, and it feels good to see that the market is following its structure, not doing something different. Sometimes it can just be very erratic. Sometimes it can just be very, very erratic. I mean, doing something unnecessary and uncalled for. So let's stick to the principle of market structure. It's undefeated. It has never lied. Even if it you think it lies, if a structure is broken, it comes for a retest. So if your structure is broken and it comes for a retest, it didn't lie. It didn't lie. So let's look at the structure the way it is again. And my roof, I want to extend my roof to the weeks zone. Now we use our floor to clone our roof. So on technical, if price pulls back, then this is technically where you should expect your next sell zone. Look at the zone. You can see price reaction at this level. We have here as a supply roof. Break of a supply roof, price returns you onto the demand floor. Break of a demand floor returns you as a supply roof. Break of a supply returns you as a demand floor. Break of a demand floor, retest, a massive sellout over 500 pip drop, and price returns here to respect the structure. We cannot uptick without breaking the structure. So we have to break the structure on double confluence. What is the double confluence? Number one, we need to break from the black ascending trend line. And we also need to break from the horizontal supply structure. So if we break from both, that means we have enough impulse to push price into the next phase. And the next phase of the market is going to be on the roof. So I also want to make it symbolic. Let me make a zone for it so that it stays active in our mind. As price returns here, we know exactly what to do. So this is the zone as already created in the purple structure. So if price breaks out from the structure, on technical, this is where it should be heading to. This is where it should be heading to. This is the first phase. Now, this is just for the 5 minutes chart. And that does not mean it will represent a longer perspective of the market. But at the moment, like you see the way price have stick to 2,930, 2,927. You can see here we have an M structure on a break of M structure, and price returns at that level where we have that neckline. This is the neckline of the double top. The neckline was broken and returned. Now price came back, broke that neckline, so it returns now to trade on top of it, so indicating that the market might be going up. And that is why you have seen that move by close of 45 minutes candle. It rejected it, and the new 4 hours candle is also negotiating a buy. So at that level, let's see what it does. If it goes back again, it will be confronted by the black ascending trend line. And there is a very high probability to respect it. But if it breaks the structure, then you must open your mind that this bullish ascending channel, we have to follow this path where I will let me note it so you see the path what the market is about to do, and you see it after establishing here higher high, higher low. Then price came here higher high, and brought another higher low, and price returns here higher high. Not really a high because it's not greater than the previous high. And this high, the way I see it, might be heading here to break the previous high, then sell down. It might not sell completely, but here becomes a reference, a support that if that structure is broken, it could find here as a demand structure on break of a supply roof. So let's see what it does. Let's see what it does. And we're in Asian session, Asian Sydney section, and we don't know the volume of liquidity coming their way. But I know the London session will soon be open. So as the London market opens, we'll see the London market is